So the idea is always expect tree wave. Okay, and of course, you don't want to overcomplicate the process by looking at like from a 5-minute all the way to a daily chart, right? So my suggestion is always just stick to maybe 2 time frames, and you just want to have the context of within a smaller structure of a correction, we always expect tree, and then within a bigger context of a structure, we expect tree move as well. Okay. Now in a while, I'll jump into some charts to actually show you as well in terms of the examples of this. Okay. So the market is moving in fractal in nature, right? So that's where we talk about the smaller time frames within a corrective structure. You can see tree wave within a bigger context, impulse, correction, impulse. You also can see tree wave, right? So within correction itself, we also have smaller impulse, correction, impulse. Okay. So this is applicable to all time frames, as I mentioned. Okay. But obviously, you don't want to overcomplicate the whole process by looking at, I say, like 5-minute all the way to daily. It doesn't make sense. Again, you just want to stick to maybe at most 2 to 3 time frames so that you get these smaller, detailed kind of like data points to work with, and then at the same time, a higher time frame to give you a better bird's eye view, overall in terms of context where the market is developing, where it came from, and things like this. Okay? So over here, I'll give you some examples of fractal and what I mean by internal and external. All right. Now over here, you can see as we are going up, okay, we do have the tree wave in terms of like 1, correction, 2, 3, right? Impulse, correction, impulse. And within the correction itself, we can also see 1, 2, 3, right? This is basically not going anywhere. It's slow, it's corrective. As it's coming down, you can see overall here is 1, 2, 3 as well. Okay. And of course, internally, you can also see 1, 2, 3 to complete one set. It does another correction here. And then 1, 2, 3 to complete another set to give you a bigger tree wave move. Okay. And of course, if you just stretch this further, right? So what we have is this is 1. This is 1. We then expect this to go up and break this high, right? To complete that tree wave expectation. And as the market is developing to the upside, we again can anticipate 1, 2, 3, right? It's unlikely just going to go straight up, right? In one line. It's probably going to do it in 3 swings, in 3 moves. Okay. So that's the whole idea of what we call the expectation of a tree wave, right? Always think about how the market is developing to a particular direction, and there's a good chance it's going to move there in sets of 3, okay? So as I mentioned, right, sometimes it's not picture perfect. Sometimes the market just doesn't give us what we always anticipate, like this, okay? So we kind of have like one move here, but this here, you can't really see a clear tree wave, right? Because the clearest tree wave is always a move up, and then 1, 2, 3, okay, where this low takes off that low, this high basically is lower than that. This gives you kind of a flat structure for an upside. Okay, so we don't really see that there. So sometimes that's how the market functions. And when things are not clear, what do? You stay out from the market, you move on to something that is clearer to you, right? So just want you to be aware, okay, it's not perfect. At times when you see things that are not clear, just stay out of the market, wait until something is clear, develop, then you start to focus on it, right? Okay, so that's the principle again, just to reinforce the idea of tree wave can be utilized on a smaller scale and at a higher time frame. Okay? So when do we use it, right? So we always want to follow and flow with the market. Okay, so we use this tree wave expectation almost all the time. Okay. Whether we are looking for entry, whether we're looking for target, we're basically using those principles every time we look at the chart. Okay, so we can of course then break this down into, as the market is developing a correction, can I trade, a shorter time frame perspective? Can I look at trading the pullback and then riding the bigger swing direction? The answer is yes, right? Because market moves in fractal. Okay, so you can actually use this principle to trade the internals of the market, which means when the market essentially is, pushing up very fast, it's an impulse. Okay, let me draw that a little bit nicer. Okay. Suppose the market is impulsive, moving to your upside, right? So the direction and the momentum obviously is up, right? But as you start to see, okay, we get a pullback here. We get a pullback here, and the market is starting to turn, okay? So we can then use tree wave expectation over here to kind of catch a short-term trade to the downside to target this low. if that's something that fits your profile, right? So this is becoming a very, very short-term trade. Okay, of course, if you are doing more of a trend following, a swing style of trader, you will then want to wait for price to complete that before you take the buy, right? You will not be too interested in this short-term sell, but you're more inclined to buy. Okay, but of course, can you trade an internal? As I mentioned, the answer is yes. Okay, you can still trade the short-term sell to the downside in this example. Okay, and of course, we can use it to wait for the bigger move. Right? So this is very, very adaptive and very flexible depending on your trade style, depending on how you approach the market. Okay, but most of the time, this is what's going to happen, right? Three-wave move in the market. To give you an idea and an illustration on a chart, right? So we have this high, the market came down very fast, obviously impulsive. Okay, and we start our first push up, we have this move down, but it's very, very corrective. Okay, so looking at this here, you know, we start to have a smaller U-turn. So we can say, okay, we have an impulsive drop. This here, this up move is slow, this down move is corrective. So we then put in the expectation of a three-wave move. Okay, so we have one down fast, okay, and then we have our first move up, second move down. We always anticipate this to come back and break this high before the drop. It's not 100%, it's high probability, right? So A, we can look at it and say, okay, price is currently here. We expect this to come back all the way here. We have a short-term buy opportunity. Of course, you then need to assess, right? Is the risk reward worthwhile? Is this trade worth my attention and things like that? Am I a short-term trader, etc., right? So you can obviously have the option to trade this to the upside, take profit somewhere there, and then look for the sell, right? You flip the entire position in the direction down. If you're more of a swing trader, then what you'll be doing, you won't be selling here. You'll be waiting for a sell somewhere at the top. Okay, so that's the application of that three-way, right? You can use it short-term. You can use it for the swing, all right? So let me very quickly, you know, jump over to the kind of like current market price chart.
Incoming mail.
Okay, to very quickly show you some of the principles that I always apply. Okay, now look at this over here. This is a chart on euro dollar on a 4-hour time frame. Okay, so what do you observe? Like, let's look at what happened in past, right? So you can see the market came down. This is kind of a near-term low here, right? Okay, how did the market move up? In sets of three, right? One, it came down two, and then it went up three, and then after that, it does a big reaction. Okay. Now, of course, internally, you see here labeling 5. Okay. This will probably have a 5-wave move to the upside as well. But right now, you know, don't focus on the 5 move if you're not familiar with anyway. But back to the principle and basics of three-way first, right? You can see how this moved 1, 2, 3. Okay. How did it came down? 1, 2, 3. Okay. So what do we expect as is, you know, after you completed a set of 3, if this is pulling back, we expect 1. Okay, maybe the pullback now is happening 2, and then we can expect a third move up. Okay, and once this is done, there's a good chance maybe this will come back down, right? Because why? This is a 1, this is a bigger 1, then this can be a 2, and then we can expect a third wave down. So we are always constantly in expectation of a 3-wave development. Now, whether the market gives us or not, obviously, well, okay, I deleted a lot of things. Obviously, you know, it's not going to be picture perfect, okay? But this is a guiding principle for us to analyze, okay, and help us to make trading decisions in the market, okay? Now, I'll give you more example, right? So you can see over here, pound dollar, how did it came down in 3, right? 1, 2, 3. We have some reaction as of now. How would this likely going to be bouncing off? We have first wave to the upside. Okay, so we have first wave up. If this comes down correctively to give us our second correction, we can then expect a third move back up, right? So the market, you always expect a set of 3. Okay, same thing over here, right? As it's establishing down, you can see 1, 2, 3. Let me move this here. You can see as it's going up, you know, from this low here, in a big set, 1, 2, 3. Okay, so most of the time that's what we are observing. Okay, same thing over here, right? Look at dollar yen. What's the analysis and the expectation as of now? We had our first impulsive move. We have a 1, 2, 3 pullback. So likely this is done, and therefore what we're expecting this to come down towards where? Towards somewhere at the bottom to break this because of the 3-wave expectation, right? 1, 2, 3. Okay, So we are always in anticipation of that, right? So look at this here as well, right? 1, 2, 3, and then internally here, 1, 2, 3, okay? There is a very high probability the market is always developing in sets of 3, right? So you use this as a principle to guide us in our approach towards our analysis and trading in Elliott wave, okay? Now, suppose this is a very fast move, right? I think everyone would agree on that, okay? This is coming down. Now, if let's say this is coming down, but we don't really get a obvious and clear 3 wave, what do you do? For me, I always want to wait for a very obvious and clear 3 wave move, right? So I want to see the market come back a little bit, and then after that come back down towards this target area that I'm interested to look for a potential trade. But I also want to combine it with a set of 3, right? So I want to see a 3 wave corrective move, something like that. Then I'll know, okay, this would be likely completed. We can start to focus on the buy trade. Okay, and then of course you can see here buy trade 1, 2, 3. Okay, now suppose the market doesn't give me a set of 3 and then just keep falling, and then comes into the territory over here. Would I be very interested to take the trade? The answer is no. The reason is because I don't see a set of 3. What would likely happen is this can still bounce back up, and after that market can come back down, before it takes off, right? So buying around this area here psychologically may not be very, very easy, because if the market continues to just consolidate at the longer period of time, then my position is basically I need to hold it longer. Okay, I'll be trapped, quote unquote trapped in that position for a longer period of time before it maybe eventually takes off, and that's going to be psychologically more difficult to hold the trade. Okay. So the principle of 3, you can see how the application is really, really wide. Okay, is really at the end of the day an element of time. Okay, now when we apply it into indices, you can see that as well, right? So 1, 2, 3, which means that we are entering very, very close to our territory of interest. So we have 3 wave move. Okay, we have an area of interest that we're kind of looking to get involved in the trade. That means that we're more or less ready that we can look for buy, right? Because we have a 3 wave completed. Now look at this. Okay. Now this one here is also an indices, is US 30, okay, which is Dow Jones. Now this one here, we don't really have an obvious 3 wave yet, right? Okay, we have a very, very small one here. If you kind of look into the details of it, we have a 1, we have a 2, we have a 3, but we haven't really entered into our territory, okay, of interest, right? So what it means that I'll be looking at this here as an entire one piece. Likely this would do another 2, and then maybe we'll wait for another 3rd move down towards this area here to complete a set of 3. Okay, so this again tells me what element of timing, right? I wouldn't be jumping into a buy too eager right now for this chart, okay? But this one here, then it's more or less ready, right? In terms of like NASDAQ, then that's where I'll pay a little bit more attention to this, because the 3 wave is completed. Yeah. So I hope so far so good, right? You guys are kind of understanding a little bit into the principle of that. Okay. So let me very quickly jump into 5 wave. Okay. Now 5 wave expectation is very, very unique, because we only use this expectation in a very, very specific pattern. Okay, and that pattern we call it crawl. But if you're familiar with conventional pattern terminologies, a crawl is essentially a wedge. It's also essentially a diagonal. Okay, so why 5 wave, right? Because again, this is a pattern that we tend to observe. It repeats itself over and over again. Now, does the market need to give you a 5 wave? No. The market tends to do a 5 wave, but sometimes it can fall short of a 5, and then it starts to react. Okay, but we always protect ourselves by having a guideline. Okay, so that it can guide us through in our analysis process. It can guide us through in our execution phase as well. Right. So the internals of a diagonal are often a 5 wave move, right? And that's why you see, if you're familiar with Elliott wave, you see traders label a diagonal in 1, 2, 3, 4, 5, right? So we kind of strip all the complexity and then just go to the core of it, to the principle of it, and that's why we say 5 wave expectation. Okay, so while there's a good number of times, it doesn't need to develop a 5 wave before it reverses, before the pattern completes. But as I mentioned, we need some sort of an expectation to guide us, right? So that's why we use 5 wave. Now, example over here, right? You can see this structure pattern is coming down by slope, right? So you've kind of recap a little bit the last session that we talked about, the crawl pattern. Okay, we say that the crawl pattern is basically where we get, an initial fast move, and then after that, the market continue in the direction, but it starts to slow down. That's what we call crawl. Okay, so when we go into the details of a crawl, you can see over here we have 5 swings, right? 1 down, which is a fast move, 2, 3, 4, 5. And once it's done, its 5 wave, there's a very good chance this diagonal, this crawl pattern is ready to reverse. Okay, and that's where I'll get our very first move. Now, this is an important expectation because you don't want to be buying here. You don't want to be buying here because if the market, as I mentioned, continue to consolidate and just move very, very slowly in a range, psychologically, it's not that easy, right? So you always want to anticipate and only get involved in the trade at a optimum time where there's a good chance the market would really start moving in your favor, right? Again, nothing is going to be like ideal all the time, right? But we just need to have some set of a principle to guide us along the way. Okay, and for crawl and for diagonal, we always use a 5 wave expectation. Okay, now the other way that we can kind of utilize the 5 wave expectation is maybe some of us, are not very, very comfortable in counting swings. What you can also utilize is you can use trend lines. Okay, kind of like when you see a crawl, you just connect some of the highs and lows using a trend line. Okay, and today if the crawl is coming down, you just need to focus on the bottom trend line and see if you can get 3 touch. Okay, so why 3 touch? Because if you can see 3 touch at the bottom of the trend line, it means that a 5 wave is completed, right? Because in order for us to have a 3 times at the bottom, it needs to be a 5 swing. Okay, that's like simple logical math, right? Yeah, so depending on which one you're more comfortable in looking at it, some people, they're very, very comfortable in swing move in the market. Some people are not that comfortable in swing. So, the alternative over here is, use some trend lines and then count the touches, right? That works as well. Okay, now the flip side is the same. Of course, this one here hasn't really completed because why? We always expect, okay, every swing, every move to break the high, right? So you can see here, this one breaks this high. So the third move up, we always expect it to break that high, only it drops, right? So what this means is that you don't want to be selling there yet, okay? You just want to be patient and look for better areas to look for sell, okay? Same thing here, you don't want to be selling here, right? Yes, short term you may play out, but imagine, take that sell, you have some decent profit, it pulls back, all the way to your break even, you may end up even experiencing a bit of drawdown. That psychology is not easy, okay? So always have some kind of a guideline. So in terms of the crawl, as I mentioned, 3 touch or 5 swing, 1, 2, 3, 4, 5. Then only you look for a sell. Okay. So this is the 5 wave expectation, right? So same thing over here, you can see, right? If you're very familiar with the principle of multi-time frame, you can even see this one here. We have some internal crawl, right? So we have a big crawl and then internally we have a small crawl. So we have 3 touch, which means this is the area that you're looking for sell. Okay, and of course you can also combine, with multi-time frame patterns. You get a first move, you get a 1, 2, 3, right? So the application of an impulse correction 3-wave move. This part is also a sell opportunity. Okay, so so this is to put things into some examples of a chart to let you see, okay, how we can actually use the principle over here, specifically for a crawl, a 5 wave expectation to actually execute it, to look for a timing, to a better time to kind of execute our trade, and then of course using the 3-wave move as well. Okay, now a truncation in Elliott wave basically means that we don't really get a 5 wave, okay, or we don't get the 3 touch, right? So sometimes it happens, okay, sometimes it happens, and but you want to always apply the idea of like what's at the end of the day, even if they don't get a 5-wave move, right? You want to ask yourself this question: what's the overall pattern doing? What's the overall structure? Okay. Most of the time, nothing changed, right? In terms of the direction, it's just that we fall short of our 3rd touch, we fall short of 5th wave. Okay. But what we need to do is then, of course, update our analysis a little bit, right? Because we initially expect a 5-wave move. We expect a 3 touch, but it did not happen. The market has moved. It's giving you more information right now. You just need to update your analysis, right? So I'll give you an example, okay, of the process. Now, of course, when we're here, we'll probably not be selling here, right? Why? Because if this is a crawl, this is a diagonal, we always expect a third touch, right? So jumping in here may not be the best timing, because if this is going to happen, then this trade here will either maybe, if you manage it, it's a break-even trade, it's frustration, it's frustrating. If you don't manage it, you may even end up with a drawdown, even worse, okay? So we'll always be waiting, right? We always wait for this. We won't sell it here, we'll wait for this. Okay. Now, of course, as I mentioned, right, it's not always going to be perfect. It's not going to always be ideal. So what happens if the market doesn't give us our third touch, the market doesn't give us a 5 wave, and the market basically just does this? Great, right? You basically just need to update analysis. Did the direction change? No. Initially, we're looking to sell here, but right now the market didn't give us that. It's more like just a little bit of a double top structure. It breaks down impulsively, taking off this low. The direction doesn't change. It's just that right now we don't look for sell here, but we wait for a pullback and then we sell it maybe somewhere there. Okay. So we need to update our analysis when the market gives us more information, but most of the time the direction is still the same. Okay. It's just that the area of interest where you're going to execute a trade, it's going to update itself a little bit, right? So as I mentioned, this is a very fast drop. You don't sell it immediately. What do you wait? Right? After an impulse, you don't sell it there. You wait for a 3-wave pullback. Okay, 3-wave principle, right? If it's not a crawl, if it's not a 5, as I mentioned, we always anticipate a 3-wave, right? So we always expect 1, 2, 3. This is the area that we can look for sell. Yeah. So far so good. Yeah. Hopefully you can follow, right? So that's what I mentioned, right, just now. Okay, we can't update the structure. This is no longer anticipation of a crawl. We just look at the mini double top. We have our first impulse. We wait for correction. We look for a sell. Okay. Good. So let me jump into some of the charts over here to kind of talk a little bit about it, right? So let me open okay, gold chart over here as well. Okay. Even commodities, right? You can actually apply the principle of 3, right? So if you take a look at this here, how did it kind of move to the downside, right? Internally, this is a 1, 2, 3, right? So after that, it did a small little reaction. It didn't really take off that high. So how will we look at it? We'll then look at this as one set, right? This 3 little move down is one set. This wave move up, and then we have this internal 1, 2, 3 to the downside as well. This complete a bigger tree, right? So in terms of bigger tree, 1, 2, 3. Okay. So what do we expect for this move to go? We expect small little bounce up already. So if the market comes back correctively, that will be our second pull. Okay, so we have 1, we have 2, we then expect to move up. Okay, so nothing complex over there, right? So let me find a crawl, right? So I think on dollar franc here, you can see this is a little bit of a crawl structure. You can see that, right? So we have an initial very fast move to the upside, and then after this, you can see it continues to go higher, but it's obviously slowing down a lot, right? So that's what we call a crawl. Okay, so if you take a look at this crawl here, we have a very nice little 5-wave move, right? 1, 2, okay, 3 taking off that high, coming down 4, and then 5 taking off that high, right? So that's where you get your 5-wave up, you get your 3 touch, right? As I mentioned again, you draw a trend line. You can see 1 time, 2 time, 3 time. You basically, before the market gives you this, you have this 2 top already, right? So you just basically draw lines to connect it. Most of the time, it'll come back there and touch it for the 3rd time. Okay. Now, obviously, not all crawls are perfect. Okay. So if you take a look at this here, we have our very first initial fast move up. Okay. Then we have this move coming down, and then we have this move going up, right? So at that point in time, we'll probably be looking at it more of a crawl. Okay. Of course, in hindsight, you can see it's a very obvious double topish structure, but when it's developing, you won't know, right? So your expectation is always, if it's a crawl, expect 5-wave, right? So you expect this to come down a little bit, okay? And you always will anticipate this to break that high before the drop. Okay. Now, the worst case scenario is if you expect a 5 and it doesn't give you a 5, you won't lose a trade, okay? You just won't get involved in that trade, okay? At this price, right? Because you're basically waiting in it to sell here, but it did not give you, so you have no trade, okay? You won't lose money on that, right? You just basically reassess the situation, and if this breaks down impulsively, taking out that previous low, okay, so what's the context, right? You wait for correction. Of course, in this scale, in this perspective, you don't really get a very obvious correction. The market just keep falling. So be it, right? You won't be able to catch every move, but you do realize that at times when it gives you a very nice little 5-way structure, you're basically protected, right? You don't get involved in the sell too early, or we call it prematurely, okay, and then get yourself trapped in a certain position, right? So this is a good example of a 5-wave crawl, okay? So in the future, when you see a crawl, right, you always want to anticipate 5. If it doesn't give you a 5, so be it, update your analysis. If it's not a crawl, always anticipate a 3-wave move, okay? Now, there are some more complex pattern that we don't really look into, like, triangles and things like that. A triangle in an alleyway structure is an A, B, C, D, E, which is a 5 internally, but we don't often see triangle. So we just want to be, we just want to focus on pattern that tends to appear itself, which is a 3-wave move or a crawl. Okay. Now, sometimes, of course, this comes with experience as well in terms of like understanding technical analysis. You can see this example in dollar franc, right? We have an up move, we have a down move, and then we are moving another up move here. So we on a bigger scale, we have a 3-wave completed. On a lower scale, we have a crawl with a 5-wave internally completed. That's what we call a confluence, right? And of course, you can see some fit levels that I'm using. Okay, today we don't have the time to go into fit levels, but fit is another level of expectation. Okay, so in terms of Elliott wave, right, we have the price action expectation, which is a 3-wave and a 5-wave. We look at patterns, we look at swing, right? And then we also can utilize some fits relationship, Fibonacci ratio relationship, as a form of expectation. Okay, so give you some kind of teaser, right? I mean, today we don't have time to talk about fibs, but why am I looking at this area? Why am I looking at 50 and 618? Because most of the time that's where the market would likely end up going. Okay. Now, in terms of 3-wave, usually it's equal move, right? Equal leg meaning from this low up to this high. Okay, that's a first impulsive move. This pullback, right? So this expectation of the next move up, okay, we'll always expect equal, more or less equal magnitude of price, right? That's what we call equal length, okay? Equal move. Of course, that's a fit relationship, right? So most of the time, if I pull the extension, right, you can see, let me just make it a little bit more precise. You can see where it came towards, right? 101.27, that's the fit relationship. That's the expectation, right? Again, it's not going to be all the time like that, but that's what we expect. Same thing here, right? As it's coming down in 3, okay? Again, it's not picture perfect, but this is how we expect it to come, right? I mean, it did not really touch it, but it came quite close, okay? Some more example over here, you can see the fibs on pound dollar, right? As it goes up over here in 3. Same thing here, right? I can take this and measure it, 100%, and then it bounced very nicely, right? And then as it comes down, okay, as it coming down to C here, you can see I've actually put that in already. You can see here, 101.27, basically taking from this high to this low to this high, right? So very, very nice, right? And then why am I looking at 50? Because again, after a 3-wave completion, the expectation of a fit is it's going to pull back towards 50 and 618, right? Look at this here, right? So very nice little 101.27. Where did we take this? From this low to this high to this high, we get a reaction, okay? Where are we targeting? 3-wave move, okay? So from this high here, coming down to this low, and then mapping it from this high, 1, 2, 3, expectation here, 100%, right? So we expect market to have a high probability of coming back and retest to this zone. Okay, 3-wave move expectation. Okay, look at this here as well, just to very quickly show you more example. From this high to this low, map it over there, where they come towards this zone, very nicely rejection out. Okay, can we use that as a target? The answer is yes, right? So let me pin you an idea. I mean, like dollar yen is a good example of a target. How we use 3-wave, how we use the fib expectation as a target, right? So over here, okay, indices is slightly different. Okay, so we'll focus a bit more in this first, right? To give you more example on that. Okay, so this one here, let's say go down to a lower time frame. Okay, so let me pull this away. Okay, so let's say this is coming down, right? So you can see here 1, 2, 3 internally. Okay, we have an up move here. okay, with the down move here, right? So even smaller time frames, you see that happening, right? So if I take this here, where did it come to? 100%. Okay, and then what does it do? It has a smaller reaction. Now, will this bounce all the way, and then just break highs and low? Not necessary, but we get a reaction, right? So this again tells you that every time you have a tree wave completed, you're bound to see some reaction. Okay, and then of course the tree wave, you combine it with some Fibonacci's, you're bound to see some reaction. Okay, which means you can use this as a potential target. You can use this for a potential entry, right? Because when you enter a trade, the ideal situation is you get a bounce in your direction, okay? And you have the opportunity to very quickly see some profits, then you can manage the trade accordingly, etc. And then of course, if you're using this relationship to put the target, you want to target there because that's where you want to maximize your profit before it bounces, right? So the tree wave principle, okay, often we use it in combination with some Fibonacci relationship. All right. So I hope so far so good in terms of like today's content and understanding of this. I do see some questions here. Okay, so if you have more questions, feel free to put it into it. I'll probably take maybe another 2 or 3 questions, and then I'll definitely need to pass the time back over to Junkit, right? So over here, I see Jeffrey asking, what is the most profitable time frame for trading currency, says Eurodollar? I mean, any time frame works as long as it fits your style, right? If you're more of a shorter term intraday, you can look at 15-minute, you can look at hourly. If you're more of a swing, then the typical time frame you probably work with is like 4-hour time frame. Okay. Now I don't really recommend traders to go beyond 4-hour. Like daily is good to give you some context. But if you're making trading decision off the daily chart, you need to be very patient, right? And end up you probably do more of what we call a position trade, which is the borderline of like towards maybe investing. And therefore, if you want to look for more of a longer term, maybe stock markets would be a little bit better. So mainly for like FX, you probably want to be shorter term, intraday, then 15 to hourly. If you're more of a swing, then like H4, right? That would be great. Okay. Cool, right? So I think Tanvi asked if it's recorded, right? So I think Junki answered that already. The answer is yes. Lo here asked which entry strategy is better, limit or stop. Okay. It really depends on the context of the market, right? Limit order is basically what we call a retracement order, right? You wait for the market to retrace, and you're trying to find a turning point. Okay, that's usually when you use a limit order. A stop order is usually what we call a breakup order. Okay, you're basically waiting for price to really move in the direction that you want before you get it. Now, for me, most of the time, under typical circumstances, I'll use more of a limit order. Okay, I'm looking for that retracement, look for the bounce. Okay, based on the completion of a tree wave, right? We look for the bounce. But when we are looking at a news, okay, when we have a high impact news coming in and we would like to write on the news and capitalize on the volatility of the news, I'll always use more of a breakout order, which then will utilize the stop order. Okay, just like last week, right, when we have like NFP, the Canadian labor market data on Friday, I would avoid using limit and use the stop order, right? Because when you're approaching a high impact news, trying to find that reversal when the news is announced is not a very high probability approach, okay? Because when the news comes out, the market most of the time would just move off in one direction very clearly. And the idea is if you try to catch the reversal, very unlikely you will catch it, right? Because when the news release, the market move off, let's say, for example, to the upside very strongly, you try to catch the reversal to the downside, you're probably not, end up profitable, okay? So when we're approaching high impact news, when I want to take a trade, usually I consider breakout, a stop order. And then if there's no high impact news, from a day to day, when I look for opportunities, usually I would say the order will come in as a form of a limit, okay? Yeah, so I hope that can give you a little bit of idea in terms of like each of these orders will have its own strengths and weaknesses as well. And then of course, based on the context, based on like when you're looking at executing a trade, then you need to make a decision, right? Which one will give you a better advantage over the other. Okay. Good. I hope today's session is at least valuable and insightful for you guys. Okay. If it's if you're very new to Wave, okay, then my suggestion is I think the previous session may be recorded as well. Yeah, you can obviously reach out to Philip Nova over here and see if they have that session to put together. Okay. Ideally, and then if you miss out, then you can actually do a review. Okay. Yeah. So with that said, I'll pass the time back to Junkit and to do a wrap up for today's session over here.
Hi, thank you so much, Kayong. I gotta say, although it was only like a 50-minute session, but it was so jam-packed with knowledge and so much to learn. Like personally, I was totally sucked into your sharing. It was really great. Now, hold on a minute while I share another slide that we have. Just to wrap up this session that we have. Just a minute, please. Yes, I hope you guys are seeing my screen right now. Okay. So actually, this is part of our weekly engagement with our clients. So we have this session from week to week basis, and today happens to be an exception where we have let the other people, like those of you who are not clients of Philip Nova, and those of you who are just like demo users with us, to join us on this session. But normally on a weekly basis, this is a client-only live market analysis session. So we have this every week. The next session will be on 14 August, the same timing, 31st August, and respectively. So this will be a weekly ongoing thing. And we would cover Forex and CFD market analysis. So those today is more of like conceptual to teach you about the basics, the fundamentals. But on a week-to-week basis for the clients, it will be very focused on the actionable trade ideas that you can execute on. So how do you participate in these weekly sessions? First of all, you can become a client of Philip Nova, to open a live account with us. And secondly, you will be notified of this weekly session through your email inbox. Okay, and after that, all you have to do is just to sign up for these weekly sessions and to reserve a slot and to tune in every week on time to hear from Ang Kayong. So in a way, there's a sense of continuity. Like every week, he will talk about a market, and you'll be able to see him update on these markets or charts on a weekly basis. So, like I said, you will receive a lot of actionable trading opportunities on both Forex and CFDs. And also you get to have this personal Q&A session with Ang Kayong himself, like what we had just now. And aside from that, you can also stay up to date with the latest developments of the MT5. And besides, you would also receive some exclusive giveaways, and we will let you know if you have any promotions. Now, speaking of giveaways, we actually do have one that is really good. So for those of you who are attending today's session, if you also become a client of Philip Nova, you will receive this exclusive sponsored FX trading course, so conducted by Kayong himself. Now, this is a e-learning course where you will have the very fundamental understanding. So there are a few modules that are covered, right? So they cover things like fundamental analysis, technical analysis, sentiment analysis, and very importantly, risk management and all. Because I believe that the session just now, 15 minutes, it was 15 minutes, but it felt like you have already learned a lot. So that was only from a 15-minute session. So what if you have this, I think it is a 7-day module, so pre-recorded by Yong. So I would say this is a very comprehensive course if you're really thinking to get serious about trading. So this is a course that we would highly recommend, and this is also an exclusive perk, we would say, for those of you who are attending today. So open an account, then you would be entitled to this course only for those of you who are attending. So at this point, if you're still thinking to need more reasons to open an account with Philip Nova, so Philip Nova actually celebrates our 40th anniversary this year, and for the month of August, if you open an account with us and fund up to $4,000, you will receive a Nespresso coffee machine for free. Now, this coffee machine is actually worth up to 250 Singapore dollars. So all you have to do is just open an account, fill in the 40th anniversary under the field, how do you know Philip Nova, and fund in the $4,000, you will receive this Nespresso machine. All right, and that is, of course, for our new account opening. So what if you're already an existing client? Do you stand to benefit from anything? Definitely. So from the month of August to September, we have this lucky draw whereby if you trade Forex, okay, then you will be able to participate in this lucky draw. With the grand prize of iPhone 14, you would also get a flight gift card worth $800. And also the third prize of this lucky draw would be a Dyson vacuum cleaner. So 40th anniversary, so obviously we are giving out 40 prizes to 40 lucky winners. So aside from the top 3 prizes, the 4th to 40th person in the lucky draw will also receive $40 trading credits. And aside from placing a Forex trade, like I said, to be entitled to join this competition, or rather this lucky draw, if you place a live trade on the QED Signal Center, which is a plugin on our MT5, and also if you trade via our Nova 2.0 brand new trading platform, you would also get a total of 3 chances to join in on this lucky draw that we have with the grand prize of an iPhone 14. So for more information, we'll definitely send you these details through the follow-up email. And going forward, if you do have any questions, don't hesitate to reach out to myself, Junkit, or my colleague Yi Jie for any queries. So we do hope that you could join us on this next session. For the existing clients, you will already receive this invitation. But for those of you who are not yet a client of Philip Nova, we highly encourage you to be a client of ours, and then you'll be receiving the invitation to this weekly live coverage session by Yong. So I think I will leave it as that for today. Thank you very much for joining us, and thank you, Yong, for the very insightful sharing. And we look forward to seeing you next week. Goodbye.